Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Rausen Pereira. The rupee on Tuesday extended its fall and breached the psychological 70 mark for the first time against the US dollar, hitting a new low of 70.08 in intra-day trading. On Monday, the currency had recorded its biggest intra-day fall in 5 years, hitting a low of 69.93 following a global currency crisis after the Turkish lira was battered. On Monday, the rupee closed as the worst performing Asian as the contagion from the collapse of the Turkish lira spread to emerging markets. The rupee has been on the downside this year, having slipped 9% in 2018. The government today blamed external factors for the rupee's fall to an all-time low against the US dollar and said there is nothing to worry about. Economic Affairs Secretary Subhash Chander Garg said external factors may ease going forward. Meanwhile, India's benchmark Sensex has been on a strong run this year, surging over 10.5%. In recent weeks, benchmark indices have hit record highs. On this edition of The Big Picture, we will analyze what is causing the rupee to fall, and we will also assess the surging markets. Joining me on the program today are Ajay Dua, former Secretary, Ministry of Commerce and Industry; Ashok Nag, former advisor to the RBI; Mohammad Halim Khan, former Secretary, Ministry of Finance; and Siddharth, economic journalist. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Khan, let me begin the program with you. First, let's try and analyze and try and put in place what's causing the rupee to depreciate so badly.
See, first of all, we should understand what is the rupee doing with other currencies. So I have jotted down some figures, and if you see the performance of rupee with pound or euro or yen, then in the last 5 years, for yen, rupee has shifted from 58 to 61. I am talking about the last figure is of 28th March 2014. It was 58 and now it is 61. Talk of euro. On 28th March 2014, the rupee was 82.57. Today it is 80.54. Compare with pound. With pound, it was 90 plus, and today it is 90.3. But when you talk of dollar, it was 60 and now 70, as you say. So, if you analyze it dispassionately, then you will see that the rupee has performed very badly in comparison to dollar. But in comparison to other basket of currencies, it is not doing so badly. In some cases, there are pluses, some cases, there are minuses. So, to that extent, as you have said, that the government is of the view that it is because of the external factors. To some extent, they are right. But then the issue is whether we can ignore the external factors. Now, if your performance with dollar is going down and your dependency on dollar trade is not going down, then there has to be a cause for concern. So it is a matter, I am sure they must have analyzed in detail whether the major trade happens in dollar terms or that major trade is shifting towards dollar terms, or the trade-off is shifting away from dollar terms. Now, if it is shifting away from dollar terms, then probably, as they say, that it is not a cause of concern, there is some weight behind that. But if the trade volume is shifting towards dollar terms, then I really don't know on what basis they can say that it is not a cause of concern.
Right. Mr. Dua, how would you look at how the rupee is doing at this point in time? The government is saying there's no need to worry, there's going to be course correction during the course of time. On the other hand, you have the entire financial crisis in Turkey. Is that playing on the minds of the traders? Is it playing on the minds of the markets? What's really happening there?
Let me start by endorsing what Halim said. If you measure the value of the Indian rupee vis-a-vis the 36 trading partners of it, the currency of the 36 trading partners, in the last 4 years, actually there has been an appreciation by 20%, a whopping 20% appreciation of the Indian rupee vis-a-vis its 36 trading partners, which means in a way you are taxing the Indian exporters because the Indian exports are becoming costlier. And to that extent, to capture the market becomes that much more difficult.
Yeah.
But if you look at isolated one currency, which is probably the world's most traded currency, and it is I would call it the major reserve currency of the world, vis-a-vis that, we have certainly depreciated. And during the current year, starting January, the depreciation which has occurred in the rupee at almost 9% is amongst the highest of the major currencies of the world. Others have also depreciated, but not as much as we have. And if there has been a positive movement, it is only the yen, which has improved by 1.9% vis-a-vis the dollar. But whether it's the pound, euro, renminbi, all of them have taken a hit, but India has taken a bigger hit. Having said that, now let's just move on to the immediate crisis. That is, yesterday what happened when the Indian currency spooked by 1.5% on the lira, the Turkish lira taking a hit. The Turkish lira fell by 18%, but the Indian currency fell by 1.5% yesterday and a little more today, below 2% in aggregate. I would call it preemptive liquidation. It is just preparing itself that just in case there is a spin-off effect, because there is a huge exposure of the European Eurozone to the debt or the bonds in Turkey. That effect through the dollar, because somebody else would have invested in dollars in Eurozone, and the spin-off could impact India. But otherwise, vis-a-vis Turkey, there is no reason why we should be directly impacted. What is required to be done, and the world is talking about it openly, is that President Erdogan must not fiddle around, I'm using a strong word, pardon that, with the markets in determining the interest rates in that country.
Right.
He wants the interest rates to be kept down. He doesn't want those to go up, and that's not reflecting the market situation.
Why is that happening? Is it because he does not read the economy well? Is that because it's a warped sense of economics that he's dealing with, or what is it really?
I think on the fiscal side he's having problems. He's not able to manage the economy on the fiscal government expenditure, government revenue side. So he doesn't want to, alongside that, also make it a high inflation economy by letting the rates go up.
Right.
Instead, artificially, in Turkey, the rates have been kept down, interest rates, only to make sure that there is less of inflation, or the pressure is felt by the population.
But it doesn't work that way, does it?
It doesn't work at all. And that's exactly what we are seeing, that 45% depreciation in the Turkish lira in the last 1 month.
Right.
And going forward, we don't know where it will stop.
Right. Let me get in Mr. Ashok Nag now, former advisor to the RBI. Mr. Nag, as far as the falling rupee is concerned, what kind of an impact does it have on the economy?
See, firstly, I would like to tell you that our comparisons of the rupee depreciation with pound or the yen or this euro is not really proper kind of a comparisons, because see, in the rupee, in our case, our forex reserves are we have a current account deficits country, okay? So we should not compare with the people. If you have to compare rupee depreciation, we need to compare with our kind of peer groups like emerging market countries, where rupee has not really fared very well as compared to the emerging market countries. But the most important point is that the rupee depreciation immediately impacts, what is our external commercial debt. Okay, if you look at our commercial debt, for almost 19% is short term, and if you by original maturity, and almost 47% by the residual maturity. That means it will be maturing within next 1 year. So either you have to roll over or you have to pay. As soon as the rupee depreciates substantially, the people or the commercial firms who have borrowed money in dollars or the other kind forex currencies has to repay, and if they don't have the corresponding natural hedging, that means they earn in the dollar or some other currencies, there is a much more kind of possibility of they are becoming a much more difficult kind of and their financial health will become much more difficult. So this is a very important part of this. Second part is that if you look at our current account deficit last year, the last quarter of this January-March quarter was 0.4%, okay, and now of GDP, now it has increased almost 5 times to 1.9% GDP. This should be a matter of concern. Of course, it is largely driven by the oil price increase, but oil price is not likely to decline very soon to a certain extent that it will give us some kind of comfort. So rupee depreciations and RBI trying to, of course, to calm the market. There are $21 billion RBI has sold since April and $10 billion forward sales. So
right.
Rupee depreciations, what is happening here? You see, forex market is driven by more of expectation. As soon as the lira declines, most of the trading, the emerging market exposures, they are supposed to be correlated. So many kind of algorithmic trading, they will start thinking that we have to reduce our exposure to the Indian market. And
Right.
that will have a certain kind of expectation. And when this expectation leaves the market, the exporters will try to postpone their bringing dollar. Importers will try to, as quickly as possible, they buy dollar. That itself actually fuels your entire market. So unless this is managed by RBI to calm the market, this is going to affect definitely the internal kind of economy. And this is to be, so if you just think that it is external factor, we can nothing to do with us, I don't think that will be a good response from the economic policy point of view.
Okay, all right. We shouldn't look at it as just an external factor. We need to do something as far as the falling rupee is concerned, is what Mr. Nag is suggesting. Let me bring in Siddharth into the picture now. Siddharth, as far as the falling rupee is concerned, who is impacted the most as a result of this?
I think the biggest impact will be on the import bill, given our huge dependence on oil imports, which in turn has an inflationary impact because, higher oil prices would translate into, costlier fuel for trucks, which ship everything from vegetables to soaps and, even automobiles. Similarly, anyone who's dependent on oil to a large extent for his production will be impacted. His cost will go up, which will translate into, inflation. Two, anyone who has children studying abroad will have to pay more for their education to buy dollars. Importers will have to pay more to, import the same stuff. Exporters technically will earn more dollars, or earn more rupees for the same number of dollars. But in real world, that does not happen because the moment the currency depreciates, your buyers renegotiate the contracts, and while the market expects the information technology and the pharmaceutical sector to do well, I don't think that the entire benefit of the rupee depreciation would accrue to them. In fact, already some of the information technology companies in their quarter results have warned about the possible impact of the rupee on when they go to renegotiate contracts or when they bid for contracts. So the win-win situation doesn't really exist for them. Everyone pays a little more, and exporters who gain will probably have to renegotiate contracts when they go for the new ones, renewals.
All right. Yes, Mr. Dua, you had it.
I think the government is probably right when they say we don't need to worry too much about it, but probably they are banking too much on the fact that our reserves of $402 billion are enough to cover about 9 months of imports. But and that they are able to, through their market intervention, shore up the Indian rupee, which I'm sure they would have done yesterday and today to a fairly large extent. But going forward, that's not the best way to go. One, if they keep on buying rupees in the market, the Reserve Bank, you're releasing your foreign exchange buying good, you are creating a tightening of liquidity in the market, and which can raise interest rates, cause inflation. Similarly, when your import bill keeps on rising, a point which Siddharth just made very right one, that all our imports are becoming costlier, that has a potential, huge potential, particularly through the fuel route, fuel and fertilizer route, to cause inflation in the country. On the other hand, our exports, theoretically, yes, should increase, but I find that our 40% of our imports are actually where we add very little value. These are petroleum, get crude oil, refine it, ship it back, get diamonds, cut them, polish them, send them back. So all that we get is a service charge there. So there, I don't think we are making very much. They show in our import side as well as our export side. Others are 60% of our exports, where we are facing major problems of competitiveness. In terms of textiles, apparel, leather goods, our so-called labor-intensive goods, we've lost markets to Bangladesh, Vietnam and other countries, and very difficult to reach that, to compete with them, because we are no longer being given preference as an LDC country, because we are beyond the $1,000 average income, etc.
Sure.
We probably have still some advantage in terms of pharmaceutical and IT, but there again, it is a very short-term advantage, because knowing that it's become cheaper for India, everybody at the first opportunity asks for renegotiating of contracts. And to that extent, we need to be worried about the fact that our dollar depreciation vis-a-vis the dollar has been already 9%, and I don't know how long will it take for us to reach 10%. That means another ₹1.50 or so.
Taking cue from what you just said, Mr. Khan, several analysts are the rupee has already breached the 70 mark vis-a-vis the dollar. Several analysts are suggesting that it could breach the 80 mark as well sometime in the near future. Is that going to be a reality? The government is asking us not to worry at the moment, because it's saying that it is only external factors. When do we start worrying then?
See, as I said in the first time, see, what you have to see whether borrowings or trade, is it shifting towards more dollar-denominated area, or it is going away from the dollar-denominated area. Now, if it is shifting towards dollar-denominated area, and at the same time your currency is also depreciating, and that too a little faster, then it is a serious case for concern. But if your borrowings, repayments and trade is shifting away from dollar domination, then probably what government is saying, probably one can have a lesser view of the problem. That is one thing.
Both are actually dollars, as you know. Most of our borrowings are denominated in dollars, and most of our trade is in dollars. So even though it might be with other countries, but dollar is the dominant currency both for our debt as well as for trade.
Okay, so let me go a little beyond the currency issue. You see, once a superpower says that America first, so that means that the dollar is bound to appreciate vis-a-vis other currencies. Now, if the other emerging or other middle income group or countries, they still feel that they can have a comfortable economic life by looking into only in terms of dollars, then there is a serious issue. Now, I really don't know whether at this point of time one can go beyond that, but diversification is something which has to be looked into in the middle and long term.
Okay, we need to look beyond the dollar is what you're suggesting. Whether we can actually do that or not remains to be seen, because the entire world is dealing with the dollar at this point in time. But let me bring in, Mr. Nag into the picture now. Mr. Nag, where does this leave the RBI really? On the one hand, you had this good news about inflation cooling off, and the inflation is something that the RBI has been very concerned about. And then you have this problem of the depreciating rupee. So where does the RBI go from here?
See, from the RBI point of view, of course, inflation targeting is the primary, the mandate for the RBI. But point is that the external, your currency depreciation has a certain kind of a effect, which, for example, if currency depreciates significantly apart from the import price through will go up and there will be pressure on inflation, the most important point, that is a twin balance sheet effect, that it will be also affecting the balance sheets of the various external borrowers who have done the dollar or debt. And it will also have also in the fiscal deficit, because a lot of our government debt also in terms of dollars we have to pay that, and your rupee values of the debt servicing goes up. So RBI has to look into this, that whether the exchange rate, if it is going beyond certain point, whether it will be, RBI doesn't have any target exchange rate, but at least in the long-term point of view. In the short term, this will have some impact. So RBI question is that how much RBI has got a leeway to intervene in the market. The RBI, the forex reserves is sufficient for around 10 months import, we have it. But we must understand that most of our foreign reserve is a borrowed reserve. We have not got reserve based on the surplus earned from the current account deficit. So that part is to be very important for RBI. So although there is a clamor for that RBI should reduce the interest rate for the growth to pick up more, this aspect will be a kind of a stumbling block for RBI to meet that kind of a demand from the various industries that interest rate must go down, must go down, must go down. In fact, it
all right.
Happen oppositely, RBI will have to increase the interest rate.
All right. Siddharth, now, what are the options really as far as the RBI is concerned? You know, what does it do going forward?
I think we shouldn't be speculating where the rupee is headed, because I think there was some talk around 80 and things. I mean, these are expectations, and I don't think we should be giving them too much credence, because it all depends on how the government and RBI react. Now, one is, of course, intervention. RBI has typically intervened to check volatility in the market, or a sudden slide. So I think they would be intervening, but cautiously, as Mr. Nag pointed out. There is a flip side to it. There is some talk on some borrowings, which is again in the realm of speculation at the moment. I think the government has to make it a little, and the RBI have to make it a little more attractive for foreign institutional investors to come in, which will get in some inflows into the country. What is also happening is that this whole emerging market quote unquote weakness or volatility is driving money from these emerging markets to the US and to Japan. People are preferring safe havens over emerging markets. So you need to make it a little more attractive for inflows to come in. Maybe think of some tools which drive in inflows, and that could check some volatility.
All right. Now, I've got limited time on the program now, about 5 minutes left, so I'm going to ask all my guests to be brief. Mr. Dua, on this issue of the rupee, should the government intervene at this point in time that it has breached 70, or what should the government do going forward?
Though in terms of the real value of the exchange value of the rupee, 70 is not too much to worry about, but because of its other vis-a-vis the exports, but because there are other effects which we've been talking about on the debt as well as on inflation, I don't think the government can afford to ignore it.
So what are our options, that having been said?
One of it is certainly make sure that the way foreign institutional investment, foreign portfolio investment and FDI keeps coming into the country, all these three have tapered off. If anything, we're talking a lot about FDI coming in. Our average FDI inflow into the country, as per UNCRAC data, is $38 billion a year, which used to be 34 in the previous 5 years and had peaked at $43 billion for one particular year in 2008. We need to continue to make efforts to get more FDI into the country. That requires policy changes, that requires stability and all kinds of things. But till last year, we were seeing higher positive FPI and FII flows into the country. This year, till August, we've barely crossed $500 million of equity and $800 million of debt. I think probably most of it has gone back to the US because the interest rates there have risen. We have to be conscious of this fact that if we have to keep our currencies in check, how to make sure that inflows by way of FDI and portfolio investments keep coming to India.
All right. I'm going to get closing comments now from all my guests. Yeah, yes, Mr. Garg.
we see in the short run, we should see that Diwali and Dussehra is approaching. So if the government could somehow lessen the burden of gold import, that should be, I think, the short-term measure which they can take. In the medium term, I will suggest, as he has also said, you see, there are a large number of pension funds. We have not been able to tackle them, and we have got that, you could say, the demographic dividend. So while in those countries where the age profile is going in the upper bracket, so if we can attract those pension funds, follow up them as proactively, then probably that could be a good source of foreign exchange flow in this country. And in the long term, of course, you have to see how to make the vehicles more energy efficient, how to switch over from the petrol to other sources of energy. So in short term, medium term and long term, according to me, these are the three obvious approaches.
All right. Mr. Nag, we've not spoken about the markets. The markets seem to have, just been surging all through the year. Of course, it's been a good year as far as the markets are concerned. The last few weeks have been tremendous as well. What's causing the markets to surge?
First of all, if you look at this market surge, it's a very, very lopsided market surge. If you look at the entire, either Nifty 50 or the BSE Sensex, only few scripts are driving. It's not a general phenomenon that it is the market as a whole is increasing. So this is some kind of maybe some effect of some particular 2, 3 or 4, 5, 6 stocks is driving the entire things. But what is more important for us to understand that what is required, that we should not have an emotional attachment to a particular kind of a rupee value. Okay. Only thing what is important for us that rupee does not become too volatile, which RBI is trying to manage it. But important point is that let market decide the rupee value. But if we have to have the rupee does not depreciate too much, we should see that demand supply factor, whether we can increase the supply of the dollar or the exchange by having a similar proper kind of a policy action.
Limited time, so I'm sorry to cut you short, Mr. Nag. Siddharth, as far as the markets are concerned, how long are they going to continue to surge, do you believe?
I agree with Mr. Nag. He's saying that it's a very, very thin market, thin basket of stocks which is driving it. So, as long as liquidity is there, people will do that. Having said that, with elections approaching, those kind of things need to be kept in mind. We need to keep a tab on oil prices, because if oil prices really go up, this whole party, even if it's a limited party, would get spooked, and we need to manage the liquidity. So where and how is difficult to predict about the market, but it's a very thin rally. So unless it becomes more broad based, it's difficult to stick your neck out and say how.
All right, closing comment from you, Mr. Dua. Should we be wary about how the markets are surging? Is there going to be some kind of a course correction really in the near future?
I think it is probably going to become a little more broad-based than it is. Certainly, the rally has been driven by about 15 or 20 stocks, but it will become large, more broad-minded as the agriculture is rural sector is expected to do well with good rainfall and higher consumption-oriented expenditure of the government. That will give.
So the dream run is likely to continue, is what you're suggesting?
I think so. Going forward, it will continue for at least a few months, certainly beyond Diwali, and that augurs well for FPI and FIIs to start bringing money back here. They should be able to make more money here, and to that extent, it will also help in containing the depreciation of the rupee.
All right. On that note, then, we'll call it a wrap on this edition of The Big Picture. Thank you to all my guests for joining me on the program and putting things into perspective for us. That's it from me. See you again next time.